Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is December 23rd. We're getting ready for the shortened week. We've got a short day tomorrow on the market, and then we have a closure in the middle of the week. So that's a Thursday close for Christmas holiday, and we're back on Friday. So it's definitely an interesting week. It's usually a little bit quieter. There's a little bit less volume. Everybody's traveling. Myself, I've got family coming into town, so I'm excited to have them here. We're going to start the celebration today and have, we're starting it off right. We're gonna have some Chinese food tonight. It's gonna be fantastic. I hope you guys are having a great time getting ready for the holidays. And as always, what I'm looking at here is kind of what I'm looking at in the market, what I might be doing, general thoughts and things like that. And of course, never financial advice in any way, shape, or form. It's just what I'm looking at. That's all we're doing. So get that disclaimer out there. You can see my sign is red today. I'm actually having a little bit of a down day. Volatility coming in just slightly today. I've got a bunch of positions on that will hopefully make some money over the next coming days as we see some extreme amount of theta decay. And we're gonna, Mike, hi, happy holidays to you as well. Glad to see everybody. We're gonna get into some trade ideas, and we're gonna take a look at what I've got on screen. And if you have any questions, please jump in and let's chat about what we might think is going on, into the new year, because there's lots of exciting stuff happening. Let me just make sure I've got my right screen up here. And then I will get this live for you guys here in 1 second. I think I'm good to go. Yeah, we are. Okay. Let's jump over to this and take a look. So the SPX, we can see this wide kind of, not wide. I've got a couple of indicators on here on SPX. I've got the VWAP down here, this blue line, and I've got quite a wide range off of that. And then I have this slightly smaller Bollinger Band that you can see here. It's also blue. We're seeing some tightening happening. We're seeing this range compress down. So we saw a sell signal here on the Bollinger Band strategy. We saw a buy signal recently, and we're just catching to the top of that. If this stock or the SPX hits the Bollinger Band, this is likely going to trigger one of these pink sell arrows that we're going to see. So coming up to the end of the year, look at how much volume we have at this particular price here at 68.45. We're trading at 69.05 today. Tons and tons and tons of volume at that one candle. And we're zoomed out quite a bit. There are this is over the past, since July, this is where the bulk of the trading has happened, is just below that 7,000 level that, Goldman Sachs was predicting that we might hit by the end of the year. We only have a couple days left. We're pretty close on the prediction, really. What I'm looking for here is slight pullbacks, as there could be some profit taking happening on the very last couple trading days of the year. That is always a possibility. NQ, we're seeing the same sort of thing. We have the point of control below, and this on, again, long time frame going back to July. We're trading right kind of in the middle of this trend line that I drew on here. The Bollinger Bands recently are collapsing. We're hitting recent highs. We haven't quite hit the highs that we hit in early December, and could be looking for a pullback. So, do you want to lean a little bit short? Maybe that's what I might be doing. It's always difficult to tell, but my sign is red today, so who knows? We all know we don't know what we're talking about whenever we do this kind of stuff. Russell at the top of its band hasn't quite hit that Bollinger. We saw the long signal up here. We haven't had it touch above yet, so that could happen as this is compressing. You can see how tight these bands are getting. Pretty interesting to see that happening. VIX, the VIX is just low. Look at that. We got a long signal on the VIX. Last time this happened was back in July. Saw VIX go up. And again, same sort of thing, just really tight compression. VIX dropped extremely low today. US oil, we had a big rally the other day. I keep talking about this, and I never did take a position. I just haven't. And my area that I like to trade is in this green area. So this was definitely an opportunity. I did not take it. Gold pushing out continuously. So point of control still way down here on the 6-month chart. something to consider. Silver, same thing. We're what, just massive move to the upside. Point of control around 48 bucks. Currently it's 71. Could that come down in a hurry? Absolutely it could. Let's look at a couple big names. Apple, still above its VWAP, very much at its point of control, tightened Bollinger Band strategy, and it is showing that we're at the lower range of that. TDD, let's not talk about that. AMD, we got this long signal back here. Again, lots and just tight ranges. Everything's trading super tight ranges. So as we kind of click through these, does anybody have any particular stocks they want me to look at and just do a quick little technical analysis on? I'll just kind of scrub through these so you can see what's kind of going on. We saw Baidu, we saw buy signal here. It didn't quite hit the Bollinger. And again, these Bollingers are all compressing down. So was this a positive move on? So this is CRG. So the long signal came on the Bollinger Band strategy at $32 and the exit was at 37. So it's a $5 return on a $32 product over the course of from August to December. So those strategies do work. I mean, technically it looks like it actually hit it here. You would have thought that it would have gotten out. The signal would have happened here, and that would have been a very nice win, like a $2 move in a very short period of time. And then that would have allowed for re-entry here at 33 and then a re-exit here. So sometimes it's okay, like if you see these spikes up, even though the signal doesn't appear, sometimes it's okay to exit because you can use this to re-enter at any time. Chewy, we're continuing to have a long signal here and we're definitely down at the bottom. So I think there's buying opportunity in Chewy. That's my personal opinion. Costco, we're down way below its point of control, just way down. Again, I see upside potential there. COP is at the top of its range. So this is where I like to play neutral strategies. Coinbase will obviously be affected by Bitcoin. Look at how tiny these bands have become. They just tighten right down. Sometimes when we see that happen and they have to explode out, we'll get a move to one side or the other when we see that tightening occurring. And again, everything seems to be doing that. Just prepping DKNG here. They're really tight. And that usually signals there's going to be a big move, you know, when we see this tightening happening here. So we saw, you know, complacency and then big move to the downside. Good afternoon, Dennis. Dennis, I know I didn't get to your question yesterday in the chat room about gamma risk, and it's because it's quite an involved answer. So I thought it would be easier for me to do a little video, and I'm going to show you today during the live stream exactly what I'm talking about when we talk about gamma risk, especially in relation to butterflies. Just scrolling through, looking for opportunity. IBIT, again, these all have tight ranges. Look at point of control, $67 on IBIT. If we scroll out and we look at where these point of controls are, $62 since September, and not a lot of volume here. So that means that if there is a move, these moves can happen pretty quickly on any of these. Gap down 4% today. Just super tight Bollinger Band. Wild. And we can see how well this strategy works here. I know I've talked this to death, but there's for people that are looking for swing trades, when we see that opportunity come, we're not seeing a lot of long signals right now, and we're looking for them. KSS, another good example of how tight this Bollinger Band becomes. Meta 664. Tightness again. I don't know what to say. We're always just looking for a potential move. So it could be really strong to the upside in the new year with some of this. QDTE, strong performer. I wouldn't swing this type of thing. You collect these types of stocks for the dividend. Nvidia trading. There's a long signal. I missed this one 2 days ago. Look at that. So there's the long signal appeared, and then to the upside. I must have just not scrolled through. That was on Thursday the 18th. So Mike, YouTube has a lot of content about in the money covered call against the leaps. Basically, you just keep your short delta below the long delta, so you protect downside a bit while allowing for some upside gain. Thoughts? You keep your short delta below the long delta, so you protect your downside a bit while allowing for some upside gain. Yes, you know, it's funny you say that. Hi, Terry. Merry Christmas. Merry Christmas to you too as well. Thanks, Terry. Interesting that you bring this up, Mike. I recently did an interview that's not going to come out until January, specifically on a trade that I've been doing where I'm doing a ratio diagonal. And I don't really love the setup of a poor man's covered call, like buying a long 90 delta position and then selling a covered call out of the money. I don't love that position because similarly to a cash secured put, you have a lot of downside risk and it's not very flat delta. Typically, if I'm going to sell covered calls or if I'm going to sell poor man's covered calls, then what I'm looking for is an income stream. That's the goal. And so when I look at that, I want to see how much capital I have relative to how much capital I'm making. In terms of a leap or a poor man's covered call where we're selling a short duration short call, the key component for me is how much money am I getting on the short call on a weekly basis? How much extrinsic value am I able to decay out of that? So that is what I'm looking for in general. So my setups on leaps have been quite a bit different than I have in the past because rather than buy an expensive in the money long call that has lots of intrinsic value that can decline, I'm just like, well, why don't I buy some out of the money calls and protect my upside? The goal is to make money off the shorts. I will get to that. I will do a little blurb about that, but let's just flip over to my screen one more time. I'm going to answer Dennis's question about gamma risk yesterday, and I'm going to use SPX options to show this. So this is a really standard butterfly. So this is SPX. If we look at the table, this is today, December 23rd. Now we're halfway through the day. It's 11:13 Pacific time. So we have an hour and 45 minutes left in the day. And when we look at the curve of a butterfly, it's pretty interesting as to what can happen. And when I say a butterfly is subject to gamma risk, what am I actually talking about? Well, gamma is the velocity at which the price of the options change. And when it comes to spreads and butterflies, what we know when we chart this is we know two things. We have a T0 line, which is this dotted line here. And then we have the expiration solid line. And we'll see this on Options Strat or in Interactive Brokers, Thinkorswim. All of these platforms have the same sort of thing. What we're looking for in this case is what is the expiration P&L and what is the P&L right now? And from a gamma risk perspective, it can be positive or negative. So in terms of a fly like this that is set up as a put credit spread, so this is buying the 690 put that expires today, selling the 690 put that expires today, selling the 6900 call that expires today, and then buying a 6910 call. So I've got a $10 credit put spread and I've got a $10 wide credit call spread in place. What happens is I collect the credit for this. But when I'm looking in terms of P&L and where gamma risk comes into play is where is the stock? What is the risk of the change of the price of options between now and expiration? And you'll see that right now where the stock is, SPX is this line right here, 6906. Well, the difference on this particular setup, this particular trade setup is such that it actually has very little gamma risk. There's the velocity at which the options are going to change doesn't change that much based on a time constraint because of where we are. There's very little difference between the profit now and the profit at expiration if the stock was to stay in this range. Now what this trade becomes a delta position. So when we see this and we have a low price difference between the current price and the expiration price, then we're not trying to gain from theta decay. That's not the game here. What we're doing is we're trying to gain from SPX moving down. So this, at this point in time, even though there's only 2 hours left, this is a bearish position. And if I was correct and I had this play on and I've got it centered at 6,900. If SPX does drop to 6,900, this particular trade doesn't make that money right away. And we go from a current P&L of like $1 to say we went to 6,900 right now. Say the market just dropped there. This position would gain $154. I'll point at that and then you can see there. So it would go up about $130, $140. Now these prices are changing as we speak. But the expiration P&L, if you look at this number right here, we've got $666 potential gain. And this is where gamma comes into play. So this is the velocity at which the options change. If SPX was to move over here to 6,900 and then stopped moving, this would become very profitable very quickly. Now, I can't change this date forward, can I? I don't think I can. At expiration, that dotted line conforms completely. This gives us, 1 hour to go. So this is the current time. And then with 1 hour to go, that T0 line becomes greater. And again, in the first hour, it only makes it goes from $140 to $220. And then in the last hour, it goes from $220 to $660. So there is an extremely large amount of potential incline or increase in the value of the trade if the stock was to go to 6,900. Now, likewise, what happens if it goes way, way down and we're in the negative part of the butterfly? What if we're out of the profitable zone? So say it goes down to 68.90, which is where the long put is. Well, right now, I actually wouldn't, even if it dropped there, it wouldn't even lose very much money. It would only lose about 12 bucks if it just went flashing down. But at expiration, over the next 2 hours, it could lose up to $327. This is what gamma risk is the speed at which those option prices can change. So in terms of butterfly, the T0 line is pretty flat. But the reason that Dennis was asking this question the other day was because of where we are in the butterfly. When we move into an area and I'm looking at this and I think, okay, well, the stock is trading right here. This is going to become a loss. And this is going to very quickly become a loss because I'm down to the very last couple of hours. It is important that I get out of the trade early. What I don't want to do is hold on because it gets more expensive very, very, very quickly. Now, I'm going to just do the reverse of this. Let's just reverse all of these trades. We do an inverse butterfly and you'll see what happens. So in this case, again, where the stock is, if this was the butterfly that I had set up, I don't have a lot of gamma risk at this point. The stock's just staying where it is. The risk is delta. The risk is that the stock is going to move down and this is instantly going to become a loss. If it does move down, I don't lose all that much. This would lose $214. But the problem is if it moves down there and then it hangs out there for 2 more hours, then it goes from a $200 loss to almost a $700 loss. This gap is big. And it really depends on where we are. So if we were trading at 68.93, very little gamma risk. But if we're trading near the peak or near the wings, it can become extremely quick. And so when I'm trading earnings on a trade like this, say I've got an inverse butterfly and I put it on, I've got the stock is trading here at the bottom, I'm looking for a move to the outside, and the move, say it doesn't happen. Say the move only happens a little ways, it goes up part of the way. It is imperative that I get out of this trade for a smaller loss, because if I wait, there's a chance that it could go up, but there's also a chance it could go down. And as it goes down, especially closer to expiration, it is very costly to do so. So in those trades where I've traded earnings and then the the stock doesn't move as much as I want, I've done like a long butterfly like this, or a short butterfly, this would be called, but an inverse butterfly, some people refer to it as. If it stays inside this tent, I close as quickly as possible. I just get out. And most earnings trades are like that. I'm closing very quickly in the morning, regardless of price, because if I wait till later in the day, it can be way more costly. That's kind of the Cole's notes on the gamma risk. Let's take a look at, Mike, did you have a stock in mind that you were thinking about leaps on? And then we'll pull up some actual examples of how we might look at that. Like, what is something that somebody might do a leap on? I mean, Tesla right now, super popular stock. If we go to the options, so the stock's trading at 483, and if I was to just close everything off, you know, how can I make money off of this? In terms of this, we're in butterfly mode. Let's go on to custom, and Mike Mueller. I play leaps on QQQ. Oh, okay, well, great. Yeah, let's look at QQQ. Do you have an exact example of what you have set up? Are you buying the 90 delta like at 400 days, and then are you selling the monthly against it? Most of my leaps are on QQQ as well, so I'm playing diagonals on those as well, and oftentimes I'll play these as calendars. And that's part of what we'll take a look at. But any parameters you can give me, then I can give you a really good example of how I might set it up for similar types of returns. So that's the thing. But maybe I'm doing really short duration. I'm looking at the out of the money calls, and I'm saying, okay, QQQ is up. I've got the 7-day call. I'm getting $216 on a $600 stock. That's not a huge amount of money. Generally buy the 80 delta, sell weekly, slightly in the money where the short delta is less than the long delta. Sure. So we'll look at it from a delta perspective. Let's do the long first. Go out here. 388 days, 80 delta. So we're going to buy this. It's going to be $12,000 order. And what is happening on this? As soon as I'm buying this is my max loss. I have $12,000. Now, this is considerably cheaper than buying $62,000 worth of QQQ, and I get 80% of the upside. So if we look at this just from a curve perspective, what do we have? We have an 80 delta position. And we'll see that here. So it's the equivalent of buying 80 stocks, but it's at a way less cost. Now, the problem with these, of course, is that the downside is here. This is where if the stock goes to 533 or 535, this is an incredibly poor choice for this particular underlying. And again, this is exactly what I just went over in the butterfly. Where is the difference between the T0 line and the expiration line the greatest? Where's this width the greatest? Well, that is where you're going to have the most velocity risk at the end. So right now, it doesn't matter. If we just scroll forward, you can see that with 90 days left, it still hasn't gotten down to the bottom. We're at a $9,000 loss if it dropped down there in October of this year. If it drops down there today, it's a $6,000 loss. So that does play in. Theta on this is negative though. So that is one of the important things. We're constantly losing against this trade. But the idea is to make money. So how do we make money off this? Well, as Mike said, he would be selling the weekly. So you'd be looking out January 30th is exactly 7 days. So why don't we just look at that? And we're selling slightly in the money. And are you selling you said less delta, but are you selling in the money, like way in the money? Let's just see what this profit profile looks like. He might be. There you go. So this is the trade. It has a positive theta decay of $16. We have a small range, and we have the ability for this trade to make money. If the market goes up, it's got quite a bit of upside. Is that if I've set this up correctly? Max profit is $250, but there's a few things here that we like. Theta decay is positive. The other thing that's nice is that IV expansion will occur. So if, sorry, that's the expiration date. If the IV expansion occurs, then there's a chance that this can get a little broader. But it depends on when you're opening these. You know, you don't really typically want to get into a position where you're opening these at highs if you think the market's going to drop. But some people play them all the time. It just depends on your setup. So this is the trade. Is that about right? 1 year out. Sorry, 1 year out on the longs. And that's how I went. Yeah. And what am I right with selling this like 78 delta call, the 614? Looks about right. Okay. Yeah, great. Okay, so that's like the typical. On this, here's the max loss. The max loss is 11,698. So there's nothing wrong with these trades at all. Absolutely nothing. We have this is great. It's like, is the profit tent to the downside? Yes, it is. We have greater potential to the downside than to the upside. We have positive theta decay. We have a defined max loss. So this is if there's a black swan event, that's the most we can lose. The max profit is low, but the max profit is theoretically on a weekly basis. So the question becomes, if we zoom right in and we say, okay, what if the stock stays where it is? You know, how much money do we make at this point in time? Right now we get 0, and over the course of the next 7 days, if the stock doesn't move, we make about $100. If we use our calculator on that, if I was to pull that up, $100 a week every 7 days, it works out to $5,200 on the year. This is a $12,000 risk. That's about a 45% return on capital. It's extremely good. And it has some downside and it has a little bit of room for IV expansion. Totally great trades. Now, I have been trading slightly differently in these cases because when we zoom out, if we zoom out, what happens? We look at, I have $12,000 worth of risk on here in a black swan event, and I don't have a lot of upside risk. You know, if the stock goes up, I lose about $1,800. So relative to the $100 a month or the $100 a week that I'm hoping to make off of this is pretty good. It's a pretty good trade. There's not a lot of upside risk. What if I can build something that is similar? So this is how I like to think about them. Let's keep the shorts the same. Say we have that same short protection. We just go to 2. I'm just going to increase the number to 2. As soon as we do that, now we have upside risk. If we're selling that in the money short. And the reason that this is happening is because we have a ratio of 1 to 2. So what I want to do is I want to have less downside risk and try to mitigate my upside risk. So what I've done here is I've increased the ratio. I've increased the January 15th calls to 3. So I have now 3 long calls. You can see my max loss is massive to the downside, $3,600 or $36,000. I have a higher probability of profit and I have a way higher delta. I also have greater theta decay, but I also have more risk. So this trade is not very good. This is not what I'm trying to do. All I have to do is slide over these calls. And if I slide these calls over, these long calls that I'm buying, what this should do is reduce the amount of max loss that I have. So this has got 22,000 in max loss at the 925. And what I'm trying to do is say, what if I get that to $12,000, which was what I was happy with having risk on before. So where do I have to go? There's my max loss of $12,000. And now what I'm going to do is I'm going to look at my probability of profit here. I'm going to look at my delta, which is neutral. My max loss is 12,000. My theta decay is more impressive. I have $24 instead of $16. This trade makes a considerably larger sum of money. Now, is it steeper? Is it worse? Let's see how the IV expansion occurs. Oh, sorry, that's the date. Let's see if the IV expansion helps this trade. If the IV expands, we have some long calls. This theoretically moves out quite a bit. We have quite a bit of room on the downside. And part of the reason for that is because we just have more long contracts than we have short. Let's reset that and zoom right in and say, how much money are we going to make at expiration? Well, the expiration P&L on this is about $130 instead of that 96. So this makes money a little bit faster. Its max profit is actually $500. So I look at this type of thing and I think this is a stronger trade. That's what I want to do. Does it cost more money to get into it? That is the big thing. It doesn't really. Let's cancel that and let me turn myself off here. The mid price on this is that $12,000, but it has greater theta decay. So it really depends on the setup. The other cool thing about this is, say the market really starts to steamroll up. It does have, the risk to the upside is not that much, except if the IV drops. So similar trade, but slightly different, and this is this sort of thing that we can look at. This is the 655. If we roll this over, we can actually adjust this trade quite a bit. We can decide that we want to put different max loss on here. This one has downside protection, and we can just kind of move that over. Like, say the max loss here is 6,000. This is way cheaper to put this on, and it has a very similar range. And if I want the range to be identical, I can just slide this over to be closer to at the money. So the break evens here, 612, 625. So we went a little bit too far. We still want that around that 610 level. And again, playing with these, the theta now is $34 a day. Max profit $700 instead of $250. So there's 3 times more potential. There's greater theta decay in a daily, but I've added upside risk. I've made this a much more delta neutral trade. Probability to profit 52%. There's always 2 ways to skin a cat. I guess they say that. It depends on how we are layering these on. What I might do is I might say, if I'm layering on my Q's leaps, if I have one that has a max loss of $5,000 because it's just cheaper to enter, in this case, the mid price is only 5,300, then I also get the added benefit of having a little more money sitting around making money in like T-bills or whatever it is that we're making from cash generation. I could afford to do 2 of these, which then really increases my weekly P&L. If the stock doesn't move at this level, this one makes $289. This has an extremely large theta decay, twice as much for half the theoretical risk. So chances are if QQQ runs up, IV will likely drop. Absolutely, IV will drop. So if IV drops, what could happen to this trade? I mean, here's the expiration P&L. If QQQ went to 680, this could lose $19,000 by going over there. So we do have to be aware. We want to keep this in a range that is not going to be totally toasting us, if IV goes to nothing. Really, it's you are still buying calls, so that's where the risk is. We could do it in a much shorter duration, and this is where I often am setting up completely different trades than this. If I was gonna, let's just clear this off. I'll show you kind of how I might look at if I wanted a bullish position on NASDAQ. I might be super aggressive on the calls. And then on the curve, so that's what selling a short call looks like. $294, $250 this week. What are we at? If it goes down, obviously it's a bearish trade. And then on the longer duration, I mean, I don't have to kill myself. I'm only going to be in this trade for a week. Like, what do I have to put up in order to make some money? It does not work with the IV at 0. Let's reset the 0 here. There's a trade that makes $178 and makes $258. It's a very similar profit profile. to selling that 619. And even here we could sell that 619. This is giving you a very, very similar profit curve. And the max loss on this is $1,900. Max profit is 323. Theta is 11. So we're dealing with that. We're dealing with slightly less theta decay because there's a little more on the 66 days. But this, you know, becomes a, well, where do we go to hit that sweet spot? Now the theta decay is $14. Max loss is 2,500. Max profit 368. And yeah, that's kind of, these are the ways that we can set these up. This was kind of how I developed my unicorn trades, right? So when we looked at the unicorn, let's see, the IV is actually quite low right now. So with the unicorn, what I'm doing is I'm going out, you know, maybe 142 days and I'm buying some calls. So let's go to the table. This is how I would set this up. 7 days out. It's like a double diagonal, but it's all calls. And so I sell the 618 and then I sell like the 625. And then I go out to May, 142 days out. And in this case, I have I'll just delete this off. So I would buy a call and then I would buy a further out of the money call. And then I would just play. This has got max loss of 7,000, max profit of 276, theta of 24, very high theta decay. And this is a double diagonal trade. That's effectively what I'm doing. So if I want to bring this in, this cost me $7,000, $7,100 to buy as a debit. And if I want it to be cheaper to buy and less risk on either side, I buy the wings in tighter effectively. And this is the same as a double diagonal. Double diagonals are extremely easy trades to manage, quite quick theta decay on this. Best entered in a low IV because if the IV expands, the trade can get quite big. So if the IV could drop, but is the IV really going to drop all that much comparatively to what we have right now? Probably not all that much. So depending on what kind of range bound trade we're looking for. And again, we can adjust. This one has a break even at 635. So if I feel like this range is too wide, all I do is I just sell this second call a little bit tighter and I sell it at the money. Now I've adjusted my range from 608 to 633. I'm going to reset this. 625 to 614 is that range. So if I wanted a trade like that, I find that using multiple strikes like this can work extremely well. These are low IV trades. 2025 has not been very low IV, so you have to kind of pick your poison as to what is going on. But in an absolute black swan event, if that was to occur, this trade cannot lose more than max loss 49.74. So half the amount of risk with almost twice the amount of theta decay as the trade that we first looked at. And again, we can micro adjust this. Like if I wanted this to not have very much upside risk, I would just buy a very tight call here, buying like almost calendarizing this top portion. And expiration P&L is $300 here, $400. So a lot more potential and a lot faster theta decay on these. Still 326, 315. And again, we can just move these over however we like. This can be calls or puts. So I'm just showing you kind of like how I might build the tent. But I quite like these setups. So that's much more similar, but this trade can make huge money, and especially if there's an IV increase, it can work out quite well. Okay, let's look at some other questions. Vladim's asking, I'm just reading Mike's comment about, I think the basic idea of the original trade was to collect the weekly extrinsic each week, then have working capital each week to manage the short. Yeah, and I would agree with that. So the working capital is like, how much money are you putting towards the trade? And so what I want to do always is make sure that my return on working capital is high. So I tend to go for things that have a slightly higher theta decay and maybe have like play a little bit tighter and go for that extreme amount of potential gain. It's like cash secured puts. Like the people trade cash secured puts at like 5 delta. I completely disagree with that because you're getting such a little value out of it, and you have tons and tons of risk. If you're going to take risk, at least have a decent reward. You know, if you play a cash secured put and you're making like 1% a week, well, you know, if you play that 50 weeks in a row and you have good entry, then you're going to make 50% a year. You know, if you can reuse that capital repeatedly, they're not such a bad strategy. But if you're playing something like a cash secured put and you're collecting just like nothing, like 0.1% a week, you know, then at the end of the year, you're trying to make 14% a year, and one big black swan event can kill the trade. And that's what I think about with this type of thing. Like a leap on Qs is great. Obviously, we need to go to entry. Then the second component is how much capital am I putting up, and do I need black swan hedges in my account? Because I don't want to have like $50,000 or $60,000 drawdowns if I have a rolling Qs leap that I've put on. So if I put on one leap each week with, you know, $12,000 worth of risk, well then in a single event I might have up to $60,000 drawdown. And if I could reduce that to half and have a $30,000 drawdown while keeping on very similar potential on the weekly basis, I'm going to do everything I can to do that. So that's kind of how I look at it. And so, you know, it's always hard. We are trying to like play the market. We're none of us are just sitting there like tasty trade mechanics and saying, oh, it's Tuesday, I'm putting on an iron condor. I don't think that's very smart. It's why we start these streams and we go through the stocks and say, where is the potential range? When I look at Qs right now, when we look at the chart on what is going on, let me try to scroll this over on the right screen here. When I look at the NASDAQ in general, you know, there's potential of going up, and for sure it can. We can gap up here nicely. But my bet is playing NQ to the downside. So when I'm looking at this range, you know, we can look at it in so many different ways, but there's a lot of indication that we're going to stay in that kind of range. And so if I am playing a weekly campaign and I'm putting on a trade, this trade, I'm either going to center it because all of these other trades were centered and they are kind of underwater. My previous trades that I put on here, this one would be doing well, this one would be doing well, but this one entered last week would not be doing so well. But this week, these two wouldn't have been doing so well. So you kind of range bound each trade as you layer them on. Some people are doing that and some people aren't doing it. And that's kind of how I think about those. So let's look at CTRA. You know, on the road, and we'll play this back later on. Okay, well, good. I can't believe you're like watching my stuff on the road. That's awesome. Thanks for tuning in. Let's take a look at CTRA and Cratera Energy. I haven't played this in a while. So let's scroll back. We've got some dividends. We have the range. We see a low here of 22.30. I have 29.95. We're trading at 25.98 right now. So we're kind of in the middle of that. And let's go over to the, let's just add this to our list. One of the reasons why I loaded up in Moomoo is because we're going to look at the potential of like earnings and things like that that are coming up. So TradingView showing earnings aren't until February, so that's a good long ways away. The last Bollinger Band strategy on Cratera Energy, if we just move this in slightly, how do we do this again? There we go. Got too much stuff on the go and then can't see anything. I don't know how you guys can follow me. Bollinger Band strategy was a win here, was long here just in August, and was a win here. So this has been a win. No new signal has occurred from the Bollinger Band strategy. The point of control is lower than VWAP. VWAP is right here. That's this blue line. And we've seen some compression in the stock price. We've got a small gap here volume wise around the $25 mark. So if we do break these levels, we're likely to come back down into this. You can see the large volume candles are in, oops, wrong button, are in this area here. That's that highlighted area. So how do I play something like this? This might be a situation where I just sell some puts. I look and I say, okay, well, what if I sell a pretty aggressive put, 24.50? It's outside the Bollinger, and can I make some money on that? We're likely trending down, not up. If I want, I might put on a strangle as well. So let's take a look at that and see what we can do and see if there's any premium in here. So I'm going to flip over to Moomoo. I'm going to go to the options chain. Let's just quickly look at the strategy builder and see what comes up. So we've got for 24 days out, January 16th, we've got max profit of $122 selling the straddle. That's selling the 26 put and the 26 call. We've got break even around 24.75, which is nice on the downside, and on the high side about 27.50. Then we've got the strangle, max profit about $50. Remember, the total risk on this trade is going to be $2,500. So making $50 is about 2% return. 24% per year if it stays in this range between 25 and 27. These are not bad trades at all. This little long call butterfly, that's kind of interesting. $74 profit, 24 days out for only $22 risk. This is where I think that I like to kind of, combine strategies. I like to think, okay, well, what can I do? Can I take this long call butterfly and that's only $22? If I can actually get filled for that, well, then now I can really stack a position. I can do a strangle, and I can do a butterfly. They don't necessarily have to be right on top of one another. So it's hard to build that in Moomoo because we get, can I do it? Yeah, let's take a look. Let's see if we can get creative. I can only do 4 legs in Moomoo, but let's go out to the 24th of January and see if we can build something that's like a little butterfly. So we've got the 26, and what do we have? The 24. And then I'm going to do it with all calls here. So sorry, I'm going to switch this put to a call. We're going to do 24, 26. And the reason that I'm going to do that is because what I'm going to try to do is, I'm going to look at this. Is this the close one? No, not quite. We're trying to get this cheap butterfly, right? So we got $27 of risk and then $121 max profit. What if I was to sell a strangle in here as well? So what does that look like? Well, it's very simple. All we're doing is we're decreasing the amount of, or we're selling a call and a put on against this. So in this case, we would, this is the 27.50. Is that the right one? 24.50. Yeah. If I was to sell a call at 27.50, well, it would be the equivalent of buying a call, right? So I just eliminate that completely. I just eliminate it. And then I just go down here and I sell a put at this level. And let's look at what our curve looks like. That's buying a put. Let's sell the put. So that is my potential. I've got 2 sold, and this is a max profit of 155. Now, if we were to do this as a straddle, which is what it looks like, we don't have very much flexibility when it comes to adjustment. But the reason I like to do more complex trades, I don't like how this is jumping around on me like crazy, but what could happen with this? Well, what I could do if the stock moves up, say next week the stock moves up, and I have collected a credit to open this trade. This one's going to be collected for for 5 cents. It's not very much, but if I was to buy back the short put, then I would take off the downside risk. So I would eliminate this short put, and I would basically be left with like a little call ratio spread. I have a max loss on the top side, or sorry, I have unlimited loss on the upside, but I have no downside risk anymore. So when we set these trades up, we can benefit from adjustments when we do this. So I might open this and say, okay, I'm going to sell that put to start, but as the adjustment comes, if the stock goes up, I close the short put or I buy a put. That can be another option. And if the stock goes down, then I might sell off one of these. I might buy back one of the short calls. So that's why I like to have these multi-contract positions in, and little things that we can think about, like how we're setting this up. Yeah, and a little bit easier in multi-leg strategy. Okay, so how would I play Citra? I would probably be setting up something along these lines. I would be saying, I want to have some sort of strangle and then some sort of call, like a straddle or strangle, and there's my max profit is only 87. It's funny, the tent looks way bigger here, but that max profit was bigger on the other one. I think setting up an unbalanced strangle is pretty smart on these types of trades. On the downside, there's not a lot of risk. So if you're worried that Katera is going to go like to the moon, then obviously wouldn't want to trade something like this. And this is where you can go out and you can just buy, you know, a longer dated position. So let's go out to June. How much does it cost? Well, you can buy like a 30 call for 95 cents. And if we look at this curve, this will help that trade a little bit. Maybe that's a little bit too far and you kind of adjust it. This is where we have to, you know, know what our brokerage is like. Buying that 27 call, still, it's not as crazy as people think. Like people are like, oh my goodness, it's so expensive. We're paying 180 bucks. Well, it's actually adding more downside risk than anything. That's what's happening. The max loss is 25.25 here. And if you scroll this out, it's now 24.62. You're taking $70 more risk by moving that over, but you're moving over your break even. So it depends on what the direction is that you think you're going to do. The other way to do it is to just sell a little bit higher call. That's how we slope these. So this trade in particular, I would call a humpback. So this is a diagonal call spread and a short put. So if you guys are looking and you're like, what is this trade? That's a humpback. It's like a jade lizard, but the dates are not the same. So if we were to look at a jade lizard or a lizard trade in general, that would be, if all the dates were the same, then you typically, a jade lizard, you can't even build one here with this particular strike selection. We could build a jade lizard there, just barely. Jade lizard means there's no upside risk. There's one. That's what it looks like. These are very strong trades. So if you thought Katera was going to drop, you can make 57 bucks on this, which is 2% in 24 days. The problem is if it goes up, you only make 750. So I kind of like that diagonalized version. I especially like the diagonalized version when we're in a low IB environment, which is not a great time to sell puts in general. So that's my thoughts on that. Okay, what other questions do we have? We're getting very close to the end, so I'll take a couple more questions and we'll get into that. We'll take a look at what we might want to set up. So we looked at CTRA. The other thing we can look at is CT. I realize you can't see that. I'm gonna just flip back over here. CT, Katera Energy, fair value $34, upside of 33%, according to investing.com. And then CTRA. Why do I have so many tabs open on this? Hold rating. Not such a bad little short interest, 4%. Price to earnings 11.5. Good performance. Nice. That's nice. This is a nice little potential opportunity there. Thanks for bringing this up, Vlad. I might take a look at that. I have traded Katera before, so it's one of those stocks. Like buy a couple shares, just be like, okay, I'm long a bit, and then I'm playing an option on top of it. That's where most of my positions function, anyways. I'm like doing a combination of I'm adjusting my overall delta just by owning a few shares, because we can do that. Moomoo not that easy to show that, but you can add 100 shares to any of these positions. And then we can take a look at what that stock looks like. And in this case, showing like a negative return. If we were to buy it, that's kind of funny, isn't it? Why is that showing negative? Oh, why that would show negative? That is because if you bought and the stock, oh, because the stock is here, right? Right, this one is below. So, and again, this is where we would, how do we function? Like how do we make this trade better? Well, I may not trade this Jade Lizard like that because it has too much downside risk. But if I wanted to buy the stock, what I might do is just go out here, buy the 24, 176 out, and then in January, 30 days out, or January 16th, we were looking at on the 24 days out, can I sell the 25? This is a short 25, long 24. This is a diagonal. What does that look like? It's a 53% probability of profit. And does this trade benefit from IV expansion? It might, right? So if the stock drops, this little trade could increase the amount of money that I have. It's got basically flat theta, so it's not really making money. And again, this is where we start getting fancy. We can say, what if I bought 3 puts and I sold 2? Well, this now gives me a slightly positive theta decay, gives me some upside potential. This is still a delta of 60, but gives me moves my break even over considerably. So this stock can drop $1. And I may not lose any money on this by buying a put spread. It also, my max loss on this trade is now $800 in a black swan event. So these are kind of like combining a married put with a couple of positions. And in a black swan event, this is only a $2,500 risk to the downside anyways, but that has some potential there. And then again, always looking, is the theta positive? That's one of the things that's important to me. And then where is my break even? 64% probability of profit, a delta of 90, max loss of 3,000. So I'm actually increasing my max loss in favor of getting some theta decay, but IV expansion may help this a little bit. So if I was looking for a long position, it might be something like this. Anyways, that's probably it for the day. It is 12 o'clock. You guys have been fantastic. All of my patrons, I'm going to see you guys on Thursday where we do the members only. We go over all the positions. And of course, you have access to all those positions anyways when you're a member of the Drawbridge Traders Club. And if you're not a member, consider it. We're doing tons and tons of trades all the time. And we do the Thursday streams are really about the positions and like looking at those adjustments and how we might function with those. So if you're watching my videos and trying to learn and thinking, oh, this is the year that you're going to be getting into options and you're going to do a little more seriously, then it's a great time to get in and be able to talk to me every day and say, hey, what are you looking at? What are you doing? Because that's how what we're doing is we're getting rich together. We're putting together trades to increase our wealth over time. Thanks so much, everybody. Let's get rich together. Take care.